Chris Kersey, how are you today?
I'm doing really well. Thank you so much, Jeff. I'm telling you, I'm so impressed with this organization, this society. I mean, global chapters. I saw the website. It's such a great mission, and you've got such reach now. So I'm very impressed, and I really do thank you for the opportunity to talk to you all. Thank you.
I thank you for taking the time and being with us here today. So we have some questions for you, and I wanted to first start out with a little bit of history. What led you from your career as a clinical practicing physician to pivot and go into the business of medicine? When did it happen? Why did it happen? Give us a little background.
Will do. So when I'm asked about my career path and decisions made many years ago, I'm reminded of the American poet Robert Frost. He wrote a very famous poem called The Road Not Taken. This is a poem about the author who is in the woods, and he is on a path that diverges into a left path and a right path. And he can't tell what's beyond the woods. He can't tell what's in either path, but he just knows that for some reason his calling is to take the path less traveled, to take the road not taken. And the poem concludes with the statement that one decision made at a moment in time many years ago in the author's life made all the difference in the world. And I think about that because to answer your question on my career path, let me paint the career scenario. I was a fourth year in medical school. Mm-hmm. I was so grateful to have some options. I had matched at Harvard for residency. I'd gotten into Harvard Law School, Harvard Business School, and just for good measure for the outside professional world, I had gotten an offer from McKinsey. So I'm very grateful for some offers. And I had already rank ordered what I would do, because you really need to have a plan before you're presented with these options, because you can always come up and rationalize anything. Where I said, okay, here's what I'm going to do if I get into certain places. So I went to Harvard Business School immediately after medical school. And I went to Harvard and I said, I just don't feel like I'm being called to be a practicing clinician. I love healthcare. I mean, it's the largest industry in the country, second largest in the world, according to the McKinsey Global Institute study. And I love Harvard. So thank you. I'm so honored. But I'm going to take the business side of healthcare. And I'll go into some reasons why I chose that in a moment. But while I'm an MD, MBA, I always tell folks I'm really an MBA, MD. I'm a businessman, private equity investor who happens to have an MD. And for that, I'm very grateful. It confers credibility and gravitas. And it's funny that my undergraduate alma mater, Stanford, now has a combined MD, MBA program in 5 years. Harvard, of course, has a 5-year MD, MBA program, and I took 6 years to get those 2 degrees. So I guess I could have saved a year of my life, but that's neither here nor there. It was a year well worth it. But what I did, there were 3 real reasons why I chose that career route. One, I just had some doubts about the degree of professional autonomy that I would have, or that physicians would have. And, again, I've not been a practicing physician all these years. I dance around that, but I saw some just payer regulations, governmental reimbursement regulations, the regulatory bodies getting involved. And there were questions that I saw that I could discern that I couldn't get answered. So that was one factor, but it was also a kind of a continuing interest in a dual thread around both science and business, both at Stanford, where I studied human biology, as well as economics, but also in medical school, where during the 4th year, I was taking business school classes. And I actually had an international consulting project sponsored by the World Bank over in Asia as a 4th year medical student. So I kind of had one foot out the door into the business side, even in medical school. But I'm just very grateful for the options that I had. And I also tell folks that I also picked this route because I saw huge upside in building great healthcare companies in partnership with physicians. Physicians are the key player in American healthcare. That power of the pen is so important. But building great companies in partnership with docs, I saw that opportunity and I wanted to go for it. So there's my long answer to your short question.
That's okay. It gives us and you a unique perspective because there aren't that many physicians who are managing PE and VC firms. And it also makes you understand when we tell you what's in our toolbox, what we need, and what our patients need. And it makes it much more real in terms of our ability to relate that to a person who has dual education.
Well, you make a great, Jeff, can I say one more thing?
Sure,
You make a great point in that, I somewhat speak the language of a physician and of that career, but I haven't lived that life. But it's a great partnership because we can bring expertise in growing healthcare companies on the financing side, but I'm not competitive to the core expertise of these docs, which are practicing great clinical medicine. So it's a nice simpatico. It's a nice synergy. And you're right. It's just been a real key differentiator throughout the career.
Great. So we have a lot of people on the call that want to get in front of firms that have capital in various stages, whether they're just starting up or whether they've gone through Series A, B, and now they're at Series C or looking to go IPO. How does a life science healthcare entrepreneur get in the door and get noticed by a PE firm like yours?
Great question. So the best analogy that I can come up with is they say real estate is location, location, location. Well, I've been known to say that private equity is relationships, relationships, relationships. You've really got to use your network and do the preparation beforehand, up front, in surveying the landscape of qualified private equity or venture capital investor who focuses on your industry, your subsector, who has the background from the investment side, who perhaps has the network of operating partners or senior advisors with whom you'd love to work and perhaps add to your board once you consummate that private equity or venture capital transaction. So the relationships drive this answer, but it's all about using your network. Triangulate, corroborate, get to know folks who know the private equity leader that you want to talk to and have them introduce you. I mean, this triangulation is a big deal. I mean, a lot of cold emails, a lot of cold calls, a lot of cold greetings at conferences and speaking opportunities, are great, but it's just hard for somebody in the investment world to triage, to filter those inbound inquiries. So use those relationships. But then away from the relationship side of the answer, Jeff, I'll also tell you that have a plan. A lot of folks want to talk to private equity and venture capital folks and brainstorm, and that's all great once you've articulated your plan. Plan meaning the company you want to form. Perhaps it's if you're in private equity versus venture where the deals are later stage, maybe it's the plan around the recapitalization, around what's important to you as the physician or the clinical founder of the company. Do you want to play a role in the post-recap portfolio company? Do you want to be chairman, chairwoman, or chief clinical officer or CEO? So have the plan. And then I'll also say as the last part of the answer, particularly in this age of inflation, for lack of a better term, it's a tough operating environment. So have a path to profitability, particularly for those private equity investors. The venture capital folks, those are earlier stage deals. You have to have a path to revenue growth in those situations. But use these general suggestions to leverage your network and to be very prescriptive, no pun intended for healthcare practitioners, when you talk with those potential investors.
So you started mentioning private equity and venture capital. I think there's a lot of misconception amongst SoPE members as to how to differentiate between them and when to try to engage them. Give us some background knowledge in terms of what are the major similarities and differences between VC and PE firms, And when should a life science or healthcare company come to seek your advice and capital?
That is a great question. To level set, private equity compared to venture is basically focused on investing with larger checks, though not always. They're larger checks. They're later stage companies generally that tend to be a little less technological in nature, a little less clinical in nature, less product development and reimbursement risk, less regulatory risk. There are customers currently buying those services and products. There is a margin model. There's an EBITDA. There's usually net income and cash flow. But where the risk in private equity transactions or those deals are in business development, they're in sales, they're in general operations. But for a private equity investor, at least for us, that's a very quantifiable, it's a very measurable risk. You can cordon it off, you can mitigate that risk, and we will take that risk all day long in conjunction with our investing track record and with the operating partners that we'll bring to bear, who have themselves seen a lot of this operational risk, dealt with it before, and built very successful companies. So the risk tends to be different in venture, where it's more technological, maybe it's more clinical, maybe it's more reimbursement. Both asset classes, they're very operationally focused. They're just focused on different aspects of the organizational charts and different facets of operations. I'll also tell you that they're both asset classes within the alternative investment bucket, if you will, in the asset allocation model for investors that have really grown and flourished in the last 5, 10, 20 years. And they're both key complements to the public equity investing done by a lot of the large fiduciary institutional investors, as well as the individual retail investors around the world. So they're just two parts of the overall asset allocation model. But as I tell folks, it's a real honor to be a steward of capital in private equity. And my venture brethren would say the same, to be a steward of our own capital, because our own money is going into each deal, but also a steward of institutional partner capital. It's a real blessing. We take that seriously. We want to make good decisions that are strategic, that are proactive, that try to differentiate us from other funds. I'm sure I'll have a chance to talk about how we differentiate as a fund, but that's a long answer. But it's really critical to understand where private equity and venture fit into the landscape. You didn't ask about the seed investing, but seed investing can be even earlier. But all this feeds into eventually trying to take these companies public or get them acquired. And you can take them public by the IPO route, the SPAC route, or you can get them acquired by other funds or by strategic or corporate partners.
We may come back to the IPO versus SPAC route later in our discussion. You know, when we perform clinical trials, in order to register volunteers and subjects, we have inclusion and exclusion criteria. What would you say are inclusion and exclusion criteria when you're looking at healthcare and life science companies?
You know, just like I say, relationships should drive the entree of a physician or your membership base into private equity. You know, we try to be as relationship driven as possible with our investing. That is at a premium in this kind of macroeconomic environment where inflation's taking hold and a variety of other factors, geopolitical risks are fulminating. So a key criterion, perhaps the first criteria, is that relationship and the context behind the people whom we're backing. And we can triangulate ourselves. I mean, the physicians should try to triangulate too, coming to us, but we can triangulate too. So it's the relationship sale and the relationships that drive our asset allocation models. But second is, and I tell folks, when you're contemplating, you know, building a business or starting a business, you know, be very strategic and thematic in how you're looking at the opportunity. You know, we try not to do a lot of Me Too transactions, you know, the 50th dermatology roll-up or the 50th adult methadone treatment center. We're looking for unique business models. And that's a key criteria for how we're deploying our capital. Because I say that by doing something unique, you're kind of captain of your own fate, you're master of your own destiny, and that it's up to you as the owner of the asset and your management team as the management team and the co-owners to articulate a differentiated value proposition and go forth, build a unique company. Now, if you don't do that, the risk is higher. You're not the 50th or the 51st company that can kind of just copy a bunch of other companies. The model's already been proven. Maybe you're tweaking the model a little bit, but the differentiated business models, it really probably is the second most important criterion that we're looking at when we're deploying money.
Jeff, we have a couple questions if you want to entertain them.
Sure. I know that you had a question, Arlen.
Yeah. Hi, Chris. Thanks very much for being on the show. One question is, how do you respond to those who say private equity is a threat to the private practice of medicine?
Well, it's a great question. So, a lot of physicians come to us saying, look, I have a practice, or I have a multi-specialty platform. We're growing. We want to touch more lives. We want to improve healthcare, perhaps in a broader zip code, perhaps with more service lines under that singular umbrella organization. And we need growth expertise, we need capital, and we need a partner. We don't need a mercenary. We need somebody who can actually team up with us, the physicians or the clinicians, and together make decisions that can impact healthcare and improve the way healthcare is delivered in America, which is one of our mantra. So for us, one of our key factors of differentiation is about our partnerability. It's just why we're in this business. Whether we're partnering with our LPs, whether it's partnering with our CEOs, whether it's partnering with our physician partners, that's a key parameter to how we're also deploying capital, to answer your question previously, Jeff. But it's also key to why physicians can come to us, and we've got a great track record in doing this, and be a team of decision makers. So if you don't want to access capital, and capital has been plentiful for several years, it's a little more challenging now. The debt markets are drying up, the equity markets are drying up. A lot of physicians just aren't going to be able to grow their company. Private equity also, and venture capitalists for years now have been partnering very successfully with physicians and clinicians. So 10, 20 years ago, we'd hear that question, and it was a good point. I think private equity had a lot to prove, Arlen, to the practitioners of healthcare or other sectors of our economy. Education technologists, pioneers, real estate, energy entrepreneurs. But now with the track record of building companies that successfully can scale, and where the physicians can either practice or be on the executive side, depending on where they are in their life stage, I think we're in a little bit different era. But I will tell you that there are firms that are probably a little more attuned to physicians and partnering with them. There are some that are a little more financial re-engineers, Wall Street type of firms, and the physicians can ferret that out in their due diligence themselves, and I think have a higher likelihood of success when they end up approaching their ultimate investor partner.
That's a good answer, Chris. Now, you have seen a lot of people come before you. Many of them fail, some of them succeed. In your mind, think of the 3 times where you said to somebody, I'm not going to fund you. And what were the mistakes that they made in their presentation or engagement that you said, you don't meet inclusion criteria, see ya?
Love your inclusion analogy multiple times. Okay. You mentioned the number 3. So let me just split your answer into 3 parts. A before the deal mistake, a due diligence of the deal mistake, so within the deal, and then a post-deal mistake. And I'll tell you, before the deal, it's probably over-promising and eventually under-delivering. And what do I mean by that? I mean, we're not perfect investors. We're acting on imperfect information. We're trying to get as perfect information set as we can when we make an investment allocation choice. But I have seen situations where, we just did not get the reality-based context around a given presentation, around a medical device company or around a value-based care or a fee-for-service platform or consolidation play. And the over-promising, it just really it does not bode well for the relationship for obvious reasons. But it's probably the most common mistake, and it's the before the deal number one example. During the deal or during due diligence, a major issue is what I say are hidden agendas or just other agendas. Mm-hmm. So if a physician or a clinician comes to us and has a great idea, it might be a great idea for a recap, and maybe they want to roll equity. But when we do our due diligence, again, nobody's perfect. We just want general transparency, but we'll just find out, well, there's another role that physician might have on some other business or maybe a whole other practice, or who knows, there might be conflicts of interest, other business interests, and that does cause problems. I mean, we really try to vet from our side everything that we're doing in that space. And we're very careful about, and you'll hear this from a lot of private equity and venture capital folks, that we just don't want portfolio conflicts. Because Jeff, if we backed you in a given company, we want carte blanche to do with that company in partnership with you, whatever we need to do to build value. And we don't want to be restricted because we have some deals that might be tangentially related, that might not allow your company to grow into that area. We want full latitude of operations, we call it.
Right.
And so hidden agendas are a big deal. And then on the post-deal side, it's under communication. That's the word that typifies this. So we will have funded you. So it's not a mistake of not funding. So I'm kind of creating a new answer for your question. Right. And this gets into a major issue just about communication cadence, about how owners and co-owners with docs and private equity folks can and should communicate. And one of our management philosophies here, and I don't mean to be half empty, because you really have to be kind of a half full person to be an investor. You need to see the upside to just deploy the capital. And particularly when you're an entrepreneur, you have to be a super half full kind of individual. But I always really do encourage more on the half empty side that, look, I want you to communicate successes, maybe even after they happen. Don't overpromise the success and maybe it doesn't happen. But on the other side, where you discern as the physician CEO or as the private equity chairman or CEO or whatever, if you discern an issue, share those issues early. Those little issues, they can metastasize like a cancer. They can grow like a virus throughout the enterprise, and it can take down the company if you don't address things early. So over communicate and aggressively communicate any and all issues to your investor partners. Those are three of the most common issues.
So in your dealings with these companies, I would assume that you always have a person on the board. And
yes.
Do you always have a person in plant? Do you have someone who sits there or is in charge of that particular asset on a more regular basis than board meetings?
Good question. Let me just make sure I understand the question. So when we recapitalize a company, these are majority buyouts. These are controlled transactions. So, I'm really into governance. Remember Peter Drucker said many years ago, he said, culture eats strategy for breakfast. So you can have a strategy, but even something that preempts the strategy is the culture. Well, I'm actually of the mindset that there's even something that truncates or precedes the culture, and that's governance. I'm a big believer in the appropriate governance model for a given portco and its culture, which then can create the right kind of strategy. But around governance, it's around paying real careful attention to who's doing what and how and where, and who's reporting to who. Governance is obviously not just the C-suite in the organizational chart, it's the board, right? So you want to have those boards that are highly functioning, that are truly diverse operationally, that can provide value and be a real brain trust to your CEO and his or her team of executives. So we always have either a formal governance board or advisory board. There are multiple members, to answer your question, Jeff, of people on those boards. They have disparate functions, different backgrounds. They can add a lot of value in differentiated ways. And I also tell folks that a lot of the meat of the functioning and the effectiveness of a board is actually not even done during the board meeting. And I think you were intimating at this. It's done between board meetings where
Right.
you're discussing issues, and board meetings can be somewhat perfunctory. I think it's great to see the whites of the eyes of your other executives and your other board members, so you can really calibrate what's the gestalt, what's the overall tenor of the company and its prospects for growth. But we do a lot around governance, and we have multiple people responsible for helping that CEO, I say, do an even better job. I mean, if CEOs are struggling, we'll deal with that. CEOs are doing well, great, but we want them to do exceptionally well, and the board is a way to turbocharge that growth.
So I know, after speaking with you initially, that you engage physicians at many different aspects of your business, and you are connected with a lot of physicians. From your viewpoint, what are the ways that physicians and healthcare entrepreneurs and life science entrepreneurs can get more involved in the startup community? And a side question from that is that I also know that you don't employ any physicians at Havencrest. Was that a strategic decision on your part? And if so, why?
Well, that's a great question on employed docs, and that can always change. So it's really just a matter of recruiting. There's no doctrinaire about that. But let me go back to the first part of the question first. Yeah. This is a great question on how doctors and your membership base and other clinicians and providers can get involved in exciting healthcare companies. My first piece of advice is, as a physician, become an expert in your specialty. Not for an entire career, but 5, 10, 15 years. Carve out a great reputation, a sterling name for what you do. It's a big deal. It's just part of the due diligence for any private equity or venture capital investor. They want to know that whatever you've done in your career, you strove for excellence. And, to be the world's best cardiovascular surgeon or something is going to take most of a career. I understand that, but just become as much of an expert as you can in your specialty. It's a real differentiator. You've decommoditized, you've uncommoditized from all your other physician brethren and sisterin out there, and that's important. But the second thing is I really am into mentorship at any age. I mean, I have some amazing mentors. I'm so grateful for their involvement in my career and my life. But no matter your age or your seniority as a physician, I know you're at the top of the pyramid in healthcare, but always find, and do this early and do this now, physician leaders in your specialty who have taken that step into the business world in whatever dimension. But find some operators, non-physicians, non-clinicians. They won't know anything about, what you do each day and every day to deliver great healthcare. But find some great operators who have been in your, market space, who have built great companies, and they will probably have worked with private equity or venture capital. Get to know them, network with them, and take the humility breakfast, like, I think all great business people have to do, and defer to them on, tell me about your career. How'd you do that? What were the key factors that allowed you to, build a great national platform doing something? I think it'll really open your eyes. I give a lot of talks about leadership to a younger generation. I say, and I don't know how applicable it is to the adult physician population, but I say, create a personal board of directors. Like, literally, it'll get you moving down the right path, because you're going to want to stack that with some heavy hitters. And if you get some great brand names, but that don't really help you a whole lot in terms of your career path, your career progression, doesn't really matter, right? You want folks who know you, who can help you, and who you can go to when perhaps you're given a term sheet from a private equity investor and you say, okay, wow, I don't really know a lot of those terms. I need some help. And of course, great counsel can help. But a great business person, a great mentor, I think, can really help you make some smart decisions about how you get involved with these exciting companies. So I'll just take this really fast. And I'll say, and lastly, look for unaddressed market opportunities. A lot of folks come to us and they're just kind of Me Too plays. They say, yes, 99 of these companies do this, but I can do it better. I'm like, I'd like to see something that's Me Too. That's not Me Too, that's differentiated. And I think if you look through the top private equity firms' portfolios, you'll see a lot of very unique transactions that they don't always work out, but they are differentiated. And that gets back to what I talked about before, that I'd rather be masters of our own destiny in that and not copy a lot of other folks.
So
Jeff,
Chris,
I'm sorry, we have another.
I hear. I'll come back to you in a sec. So, Chris, these are great learnings that we have been really trying to teach and reinforce to the gentlemen and ladies on this webinar and on all of our events. I hope that you listen, guys, because what he's telling you is have a value proposition. Look for something that's not already on the market. And don't try to do this yourself. You have to build a team of people who are more expert on the business side of things than providers and life science people usually are. Arlen, go ahead.
Yeah, Ross, do you want to unmute your mic and ask your question?
Sure, thank you. Thanks, Chris, for being here.
Oh, you're so welcome. Thank you.
I mentioned to Arlen in the chat, just kind of an observation and a question circle back to you. So I've noticed a wedge between VC and PE, primarily in terms of team composition. VC seems to be still tending towards doctors as SMEs, as either operating partners or venture partners. But I've noticed that PE firms tend towards the Wall Street iBanking types. And that's including Blackstone's growth equity team, Blackstone Life Science, Carlyle, et cetera. So it seemed a bit odd to me and some of my business school classmates who are all doctors that these large mega funds are still tending towards people who may or may not necessarily have healthcare expertise to join healthcare teams.
Right.
From your perspective as an MD, MBA, how do you recommend anyone who has a doctorate and is practicing, residency trained, board certified, and expert in the field, like you said, if they want to break into PE, how do they go about that without saying starting at an analyst level or going to Wall Street and doing iBanking for 2 years? What is the differentiator to actually break into your industry?
Okay, right. This is a great question. Two-tiered answer. One is, firms like ours, or maybe it's beholden to my background as an MD, MBA, there are hybrid firms that we're not a venture firm. We're not a big buyout firm that's pure Wall Street. We're in the middle. And that's why the second part of the question for Jeff that I didn't quite answer is on employing docs or partnering with docs. We partner with docs at every single stage of our due diligence of the life cycle, whether it's deal sourcing, whether it's due diligence, whether it's governance post recap on the boards. That's how doctors can get involved. They're involved with us at all those stages, and we love partnering with domain experts, market space experts, and doctor experts in those areas. So that's the part A to your answer. But the second part of your answer is a great way for you to get involved too are through expert networks. And there are expert network consulting firms, advisory firms that you can talk to, and we can get you names of those firms where your physician credentialed background is perfect to help with due diligence for a hybrid fund like ours, or in many cases, these hedge funds. Hedge funds were really the first financial service type platform to engage a lot of these expert networks for very quick, because hedge fund world is a very quick, much higher turnover world than private equity, where we have long investment horizons. But you can get involved with these quick turnaround due diligence projects for hedge funds, and they can get to know you, you can get to know them. And I think as you add value through your expertise with due diligence with us or hedge funds or other private equity firms, guess what? They're going to be calling you for more than just the one-off opinion on, does this medical device work? You show an interest in the strategic side of business, in a capacity, wherewithal to join a board or two. That's the kind of nature of the next call. Oh, hey, Ross, could you maybe be an advisor to this portfolio company? Always say yes, unless there are clear reasons to say no. And then the next call is, oh, could you move from an advisor to a board director for this portfolio company? And then you're balancing your practice. You might love it. You might want to be doing something else. The next call is going to be, hey, do you want to be a formal senior advisor to us? And we have senior advisors and operating partners who are, physicians and payer CEOs and health system CEOs and policy gurus. Then you have that kind of role. Then you're kind of in the enchanted land, meaning you're in the firm, and as an operating partner or senior advisor, you see a lot of deals and you can pick the opportunities that are most compatible with your background. You can say, hey, Chris or whoever, I really like this kind of company, and I like to take this kind of role in that company. And so you've changed from an agent to a principal, and you're able to make career decisions that are best fitted for you. That's the trajectory, and hopefully that makes sense. But it's a great question, Ross.
Thank you.
No, I think that what you said in terms of companies like GL and Deloitte Healthcare Consulting are ways into this industry for physicians.
Yes, and that's a great full-time versus my truly part-time avenue to get into private equity. And it really just depends on your life stage and your capacity to do other stuff besides the practice of medicine. But hopefully that helps.
All right. In a recent Wall Street Journal article, you were quoted as saying that PE firms need to pivot during these very turbulent economic times. How does your quotes, longer hold times, thriving in good times and bad times, add on deals to increase growth, how do these all apply to healthcare and life science ventures that you see coming in front of you?
Oh, great question. Yeah, that was a very interesting topic and interview, and it seemed to be kind of a watershed article there. I'm grateful for the connectivity with the Wall Street Journal, but there have now been a tsunami of interviews and articles and reporters asking about this new era of inflation, of geopolitical risk. And the thing is, it's like a completely different business environment than 6, 9, 12 months ago. It's amazing. So very apropos topic, but let me go into some detail on aspects to how to answer your question. And the first thing you mentioned was holding periods. And, holding periods for private equity, venture capital tend to be a little longer holding periods, but in private equity, the average holding period for a portfolio company in 2014 was like 6 years. And in 2021, 7 years later, was 4.25 years. I mean, a material reduction in the amount of time that a private equity firm holds a company before there's an exit. That's changing. That's going to revert back to the mean. It's going to elongate again. Who knows how long? And you ask, well, why? Well, because now private equity and the CEOs of these portfolio companies are really having to hunker down. Their margin models are being squeezed. Their pricing power is going away. I mean, consumers aren't able to afford their products and services because of the inflation effects. So I just do think we're at the beginning of this age of inflation. There's a lot of debate out there about where are we in the inflation curve and the interest rate hike curve. Are we in a recession? I think this is serious. We've got to be aggressive, and CEOs have to be proactive because also their employees are leaving. There's a labor shortage. There's a lot of leverage by the employees to say, hey, unless you pay me X% more, which is probably a pretty high percentage more, I'm going to go to this other place. So all these insults, all these issues are facing CEOs. And in healthcare, it's changing just like in any other sector. So to answer your question, Jeff, a key part of my answer to the Wall Street Journal was, I think there's going to be a real focus in healthcare, particularly on two things. One, a real drive to relationship investing versus mercenary investing. But second is, because that first one is semi-obvious, but the less obvious one is I think you're going to see a real focus on what I call essential healthcare service company investments and essential healthcare medical product investments and essential technology-enabled healthcare service companies. What do I mean by that? The essentiality of the company is going to be companies that aren't subject to governmental shutdowns. That was a big problem 2.5 years ago when all of a sudden, boom, things were closed, no revenue. Companies had to figure out how to afford their interest rate payments. They had to figure out how to use and infuse technology into their businesses just to survive, because if people couldn't come to the clinic, they had to do it over telehealth. They had to figure that out and pivot immediately. But also
can't operate over telehealth.
That's right. And so now they've pivoted back to being mostly in person, but they've shown that they can infuse technology into their business models. But the essentiality is also part of the less government reimbursement risk, and importantly, less susceptibility to all the discretionary spending by the end user who will pull back in times of inflation. So,
but those are not necessarily in congruity with each other, because if it's less discretionary and less reimbursement, all of your cosmetic procedures are going to decrease.
That's right. And that was one of the specialties that got really hammered in the short term in the pandemic era. But I'll tell you that, and it's probably actually, interestingly enough, one of the specialties that's least amenable to telehealth. There are some cerebral or some cognitive specialties like behavioral health, some primary care that lend themselves more to technology, and some that are purely procedural that just aren't going to be able to pivot in that way. And it was tricky. But
right.
That was about a 6-month phenomenon. But what we saw in our portfolio companies were very quick pivots to technology and a reintroduction of nice revenue growth maybe 6 months later. But companies were better for it. I mean, this inflation era and the pandemic even, they both forced a new era of private company leader. And again, I think our companies are better for that.
All right. So I have a little article here. Oh, before we go to that, what was your add-on deals? How does the PE firm help? Are you talking about add-on deals from other portfolio companies that the PE firm owns, or other PE firm may own?
The former, mainly the former, meaning you invest in company A, you put X amount of money in that, you've got a nice differentiated platform, maybe a physician runs it, maybe he or her, they're chairwoman of it, and you want to grow it organically. And as you paint this scenario that I think you're going to talk about, a lot of PE has been just consolidation plays, adding companies X, Y, and Z to company A to just grow inorganically, to drive revenue, to drive EBITDA. But, the nuance here is a lot of funds have realized that that's very tricky in this inflationary environment because of the interest rate, the interest payment issue. And there's been a refocus on organic growth, real operational improvements, not just tucking in more companies, putting in more equity that might be actually quite dilutive from a return on equity perspective, but where you've basically just created the market leader because you've put everything together, mixed it in a stew, and hopefully the final stew product is tasty. That's inorganic growth, and it's dangerous, but that's the context behind your question.
Okay, got it. So I wanted to give you this scenario and help to explain it to the people that are listening, because I don't think it's that easily understood by most of us. Higher rates have finally breached the engine room of private equity deal-making machine, the leverage buyout. Until March of this year, the playbook for a private equity firm was tried and true. And here are the bullet points. You find an attractive platform company that is best in breed for a particular market segment. Then you find a group of Wall Street banks that'll finance 70% of the purchase price through syndicated loans and high-yield notes. Then you lock into a cost of funding that floated 450 basis points above a sub 1% overnight lending rate. And then you use the platform company to make smaller bolt-on acquisitions that are even easier to finance. And that was the playbook that ultimately produced an unprecedented one-year horizon return of 54.9% for global PE for the period ending in Q2 2021. Now enters the Federal Reserve, March of 2022, 3 percentage points rate hikes later. It's the fastest tightening in a 6-month span since the 70s, and the playbook goes out the window. So give us some context as to what they're talking about and how these interest rates have altered your everyday workings of deals.
Wow, what a setup. And this is a really important scenario. But let me just continue on kind of my contextual answer a couple minutes ago. So you got company A.
Yeah.
You finance that, and let's say it's worth $100 million. The typical private equity firm or venture firm is not going to write $100 million check. They're going to write a 30, 40, 50, $60 million check, or who knows, but somewhere in that range. And the rest of it's fueled by very cheap, very available debt in our previous era of, the Fed getting involved, as you said, back in March. Everything changes when the interest rates change, because that company A, as I said before, is going to have a bunch of bolt-ons by those private equity firms. And I called them at that time companies X, Y, and Z, that because you've got company A, that's a good company, it's got some profitability, the private equity folks can go to the banks and even get better rates and even cheaper debt when they finance companies X, Y, and Z's acquisitions to bolt on to company A. So it always a very nice process. Now, I don't want to simplify it. It doesn't always work out. There are always issues, but that's a very strong return profile. And Mr. Clark is definitely right. He has a great repertoire of articles. He's a very respected author at PitchBook. So what he says is very much accurate. But what I want to also mention is there's a new sheriff in town in a lot of ways in private equity. And it's not the leveraged buyout where you're leveraging these things to the hilt. As you've heard, you've got big interest payments. It's the growth buyout, which is really our sweet spot deal type. So again, leveraged buyout, lots of leverage versus the growth buyout, where that type of transaction, you're still using some debt, but it tends to be 2 turns, 3 turns, 4 turns of EBITDA. So if you have 5 at EBITDA, just to keep it simple, it's $10 to $20 million of debt versus 40, 50, 60 million of debt. So you're using debt and you're still susceptible and sensitive to interest rates and interest rate hikes, but you're less susceptible. There is more flexibility in the initial deal around your ability as a private equity firm and as a CEO to adapt to this tough operating environment, to make changes, to upgrade your business model, to introduce new products or services that maybe are a little less inflation sensitive. Maybe you have to invest in the sales force. Maybe you have to make some geographic changes. But the point is you have the flexibility to make those changes and to improve your business in a way where in the leverage buyout, you better keep that cash flowing every second because you got those high interest payments every time in lockstep. If you don't make it, major issues around an upside down balance sheet, an over leveraged capital structure, and it's big trouble time. So the growth buyout is more common for our type of firm than the leveraged buyout. And I think it also, it gives these portfolio companies, as I mentioned before, a chance to improve. And in the end, those companies will be stronger having survived this era.
And I think that speaks to the point that it really is the differentiating factor between VCs firms and PE firms is that portion of debt in the capital structure, why you need to have companies that have EBITDA, because otherwise you can't manage that debt on a monthly basis.
It's a great point. And, it's kind of like a barbell. Think of a barbell with a thin middle portion and 2 large end portions. But here's my analogy for private equity. The big private equity, hedge funds, public equity investing, the big end of the barbell is very susceptible to outside market forces, meaning what I said about the leverage buyout, you have no breathing room, you better keep the cash flow going, lots of exposure. On the other end of the barbell are venture, big exposure, not because of necessarily the same reasons, but in that when the markets dry up in venture, they really dry up. The beta is much higher. The volatility is much higher around the availability of funds. So again, big barbell, lots of exposure to macroeconomic forces. But in the middle, much less exposure. There's still exposure, but much less exposure for the lower middle market private equity funds like us doing growth buyouts because of that flexibility factor. And I think that's going to bode well in this environment. So on the back end of all this, in a year or two or whatever the timeline is, I think a lot of the lower middle market companies are going to have performed the best.
Yeah. So in our last couple of minutes here, Chris, and thank you for the knowledge that you've shared with us today. Give us a little bit of background about Havencrest and what's your value proposition and what differentiates Havencrest from other PE firms?
Well, thank you. Thank you. Well, first, let me say, we're a Dallas-based healthcare-focused private equity firm. It's a real honor to be in this business. We're so grateful for our team members on the investment side, our operating partners, our advisors, our limited partners. It's a blessing to be in this business, and we take it as a real honor. So it's just the way we operate the firm. We really do focus on differentiating. And just like the era of inflation is going to push a new generation of private market leader to the fore, I also think that this era of inflation and of just a tough operating environment for the time being is going to usher in a new era of private equity fund manager leader. The big firms will be there. They're great brands. They do a great job, but there's a real need for the next generation of private equity fund. And it's exciting to be in this sector. Private equity is flourishing. I mean, it's a big deal when Vanguard and Fidelity are thinking about and implementing private equity ETFs. I mean, major moves for liquidity for private equity. So I think it's important to understand private equity. And once you're in private equity, to understand how to differentiate. So very quickly, we're very thematic in how we approach the marketplace. We want to invest in secular themes that have long-term tailwinds, areas like behavioral health, particularly adolescent behavioral health, areas like value-based care. We've done 5 value-based care investments. We've had some very nice exits. We're probably one of the most successful and most frequent investors in private equity land in value-based care. That's a real differentiator. But we also like to differentiate thematically by doing unique business models. And I mentioned that before. I'll also tell you that we love partnering with great operators. The reason we're in this business, and I say this all the time, is that we get to partner with the best CEOs in American healthcare, many of whom are physicians, many of whom are not physicians. But to partner with these folks from the entire life cycle, to finding deals, to due diligencing deals, to then going on boards of our deals, really does inculcate strong relationships with these operators who then come back to us very frequently. It's not atypical for me to get calls from operating partners that say, hey, Chris, hey, we've worked together before. I got a real interesting company. You need to buy it. I'll invest. I'll be your chairman. I'll be your chairwoman, and we can grow it and create a national platform. Well, obviously, we love those kinds of deals. So that's how we differentiate, by leveraging those operating partners. It's so fun to do what we do.
That's great. That's great. I have one quick question from one of our listeners. How do you feel about ARR versus EBITDA when investing in a healthcare company?
Oh, very good question. So, I'm asked, what are the mistakes in due diligence from a different angle, not the personnel level that you would ask, Jeff, but more the mechanics and the financial accounting and the overall due diligence. And I actually really do answer consistently that it's quality of earnings. It's the market analysis, the expert network analysis, the legal due diligence. They're all important, but the real sine qua non for excellent due diligence is in the quality of earnings. And it's around ARR versus EBITDA. And what's the nature of the EBITDA? So the answer to my question really focuses on the quality of the EBITDA. So the other Q of E, not quality of earnings, but quality of EBITDA, and how that EBITDA is characterized. So it's all about cash. So we really do put a premium on cash collections in the revenue cycle as part of our quality of earnings study. But it's a great question. But in the end, you've got to watch how cash is managed, but then step back and look at how EBITDA is being characterized, because it's the EBITDA characterization that's going to allow you to have a multiple at which you value the overall enterprise. And you've got to be in this environment. You don't have to let perfection stand in the way of good, meaning you don't have to have the perfect EBITDA multiple entry price, but you got to have a fair entry price so that you actually have some investing margin for error. You can make a return on your invested capital. But the issue with a lot of the deals that get done lately is that the funds only get the deal because they paid the highest price. I mean, they paid some sky high multiple. Great, they get the deal, but they have so little investing margin for based on their EBITDA multiple that, and I see this all the time, that maybe they executed really well for 3, 5, 7 years, but it was a 1.5x. there just wasn't a lot of alpha in that. And that's not good for anybody. That's not good for the physician founder who rolled some equity. It's not great for the CEO who spent 5-7 years building that company and there wasn't a lot of upside. So it's important to be aggressive in the initial negotiations, use your Q of E to quantify the EBITDA, and then price that asset appropriately as you close the deal. Great question.
Thank you. Yeah, good answer. Well, we're up to an hour. And I thank you so much for mentoring us and sharing your learnings with us. I think that it was particularly important in today's turbulent economic times to hear this directly from you. And thank you so much for all of us from SoPE. Thank you all for listening today. Please, we will post this on the SoPE website and on the YouTube SoPE channel. Tell your friends to listen to it. They may learn something. Thanks, everyone. Have a good rest of the day. Take care.